Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent, and today we're going to be doing 4 stocks with X dividends next week. Now, I already made this video. It actually turned out to be right around 30 minutes. I did the whole screening process using dividend.com, Y charts. I had some good information in there, and I took all these stocks, screened them, for price to earnings ratios of 25 and under, because that is where the S&P 500 average currently is as far as the price to earnings average. And then from that point, I screened them for stocks that had a yield above 2%. Anything below 2% I removed. And then from that point, I went individually and looked at what stocks have increasing revenue, net income, and free cash flow over the last 10 years. And that left me with these 4 ones here. So I made this entire video here. I thought it was really perfect. And then when I went to listen to it, because I always listen to my recordings afterwards to make sure that they sound, good. And I had no audio. My mic was actually muted on my actual headset because my kid was playing in it. So that is my bad for not checking on that. So now I'm re-recording this and actually have the 4 stocks here already done up. And let's go ahead and break it down as to why these 4 stocks made the list. So we did have the dates chosen were from April 23rd to April 27th using common shares. I then sorted it by the DARS rating system, which we've already gone over every single week. So every Wednesday, I put these videos out talking about X dividends that are coming up next week, and we screen roughly around 40 stocks, and we'll get stocks that all have PEs under 25, yields greater than 2, so we get some sort of return for our investment. We also look for rising revenue, net income, and free cash flow, because those are all key aspects like financial metrics when you're looking at dividend stocks, because when push comes to shove, the free cash flow is what's going to be paying you dividend. And we're also looking for a couple other factors as far as, we like that dividend growth, how long they've been paying out or increasing dividends and paying out those dividends, and also the payout ratio. So we did screen all the stocks between a 2.6 and a 5 ratio. So that was all the way from Lakeland Financial Corp to it was HNRG. Now there's a couple of names in here. Coca-Cola, for example. Lowe's was in here. Clorox was in here. But there's a whole bunch of them that are not, well known. So the whole reason I do this X dividends coming up next week is because I like to research stocks. These stocks aren't always going to be represented on the news, or they're not going to be flashing on some page saying, hey, you should go out there and take a look at Clorox right now, because their free cash flow, their net income, their revenue, their PE, and their yield is so and so. So I like to take a look at this because now I have 4 stocks. I can go look over their last quarterly, their earning reports, take a look at their last 5 to 10 years of 10Ks, their annual reports, and kind of make a decision. Take a look at their balance sheet. Where's their money going? And then make a sound decision whether it's worth adding it to my portfolio. Now, I have owned Clorox and Lowe's in the past. I no longer own them, but they are up in today's video. So number 1 that came on my list here, so let's go ahead and remove these. We're going to put these in order of how long they've been paying out dividends. So number 1 is Clorox, followed right behind by Williams-Sonoma, and third is Fast, and number 4 is Hallador Energy. Okay, so again, these were all, let's go ahead and blow this one up. So these were all chosen because they have a price to earnings ratio under 25. They have a yield greater than 2. So here, as we kind of flip through these, you'll see that this has a PE of 16.09, yield of 3.19, PE of 23.4, yield of 2.63, and a PE of 6.4 and a 2.29% yield. One thing I do like to show, let's see here, Yeah, we didn't go over the revenue, free cash flow, and net income, so we can do that over the last 10 years. And I like to look at this over a percent because you can just take this number here and divide it by 10. So Clorox, for example, they haven't done very well. If you divide 50 by 10, that's 5% per year. 30 by 10, that's 3. 14 by 10, that's even worse. That's 1.4. So very low growth as far as revenue, free cash flow, and net income for Clorox. That could be why their price did come down. If you take a look at their price recently, their price was up quite a bit and then has came down quite a bit within the last few months since February timeframe. Williams Sonoma, they're up very nicely. Free cash flow wise, up 552%, 54% average per year. Their revenue, the price is up 84%. Their price did come down as of going into 2016. This is a furniture store, so they sell some high quality furniture, I guess. I've owned this one as well in the past, actually. Williams Sonoma. I owned them for a short time. I believe I swing traded them. I did the X dividend. I captured the dividend, waited for the stock to come back and recover, and then sold it off at a profit. And their revenue is up 35% over the last 10 years. So pretty good looking numbers there. Number 3 is Fast. These are all very solid numbers, all in the hundreds, meaning that over the last 10 years, they increase in free cash flow, price. Oh no, free cash flow is up a little bit more. But their revenue, their free cash, or their price, their revenue, and their net income is up roughly 10% every single year. So it's very healthy. Whereas their free cash flow is up roughly 16% average per year. So this is actually a very healthy looking stock right here. It has came down slightly due to the correction that took place here in February, but overall it looks like it's a pretty good stock for the long term. And then number 4, we have Halliday Energy. Over here in the red line, their free cash flow is up 3.14,000% over the last 10 years. Their revenue is up 201. Their price is up 132%. That seems pretty. Oh, this is a $6 stock. So yeah, it's going to show some high numbers just because it's a low price stock. I'd looked into this one. I thought it was kind of interesting. They trade at around $7. They were trading at nearly $14 at a point in 2014 and then have fell down, very hard since then. I believe they did cut their dividend. Yeah, they don't have a really good dividend track record, but that is it. Now, if you're interested in checking out dividend.com, I do have a video on, I've screened AT&T, for example, of how the X dividend is pulled, or the dividend payout is pulled from the price of the share. So, for example, AT&T is one that I use in my example. It was a $40 stock. They pay out $2 for the year. Divide that by 4, that's 50 cents. So if the stock was $40, they remove 50 cents for the dividend payout. So the stock price would go down to $39.50 at the next opening. But of course, it had a really good example. I had pictures in that. So check that video out, top right corner, and then Clorox here. So next, we're going to go ahead and go over Dividend.com. Now we've already talked about which stocks are the strongest. So I said Clorox was the strongest. Why? Because this does have a little bit higher payout ratio than I like to see. It has a 68% payout ratio, meaning that the earnings, I believe when I bought them, they were at a 59%. So they were underneath the 60% rule that I like to follow. Their earnings I think their earnings haven't been amazing, which we looked at their graph over the last 10 years. Their revenue and net income hasn't been all that amazing every single year, but they do have solid dividend growth. So they've increased their dividends for the last 40 years. Imagine having a job for 40 years and every year you get a pay raise. That's essentially what they did. You buy the stock and you hold it, and every single year they increase your dividend payout, that cash flow that you're getting. So if you were to buy $100 of Clorox, you would get $3.03. If you bought $1,000, you would get $30.30. If you had $10,000, you would get $303 at the end of the year. And I say those numbers because I use M1 Finance, where you can use specific amounts to invest in the stock market, and you can buy partial shares, meaning you can have, it wouldn't matter if you put $10,000 into this, you don't have to buy complete shares. You can just buy partial shares using M1 Finance. And I've seen people do that. And I do that myself. My wife has her account over on M1 Finance. Number two, I would say Williams Sonoma. This is, again, home furnishing store. I owned this one here in the past. I thought it was a pretty good stock. They have a very nice, healthy payout ratio, 41%, meaning that even during like tough times, if their earnings were to be cut by 50%, their payout ratio would bump up to 80%, but that's still healthy. And they've had continued dividend growth for the last 8 years, and they have a pretty solid dividend yield at 3.53. Now, Clorox, I didn't mention, their ex-dividend is on April 24th, which is next week on Tuesday, so you do need to buy this one on Monday or prior, and then you would get paid out on May the 5th, or I'm sorry, May 11th, right there. Now, they have a pretty solid track record. You can see here, they just increased their dividend from 84 cents per share to 96 cents per share. So that's a very nice looking dividend right there. So I'm not sure if this is including, yeah, they've been paying out and increasing dividends since 1978. So prior to me even being thought of. Williams Sonoma, again, we've already talked about the general numbers up top. Their ex-dividend date is on April 26th. April 26th is, of course, Thursday, so you do need to buy the stock on Wednesday or prior, and then you would get paid out on May 25th. And I believe they recently increased their dividend. Yes, they did. They increased it from 39 cents to 43 cents. So that's a very nice, healthy dividend. I guess we could do the calculations on there. So all you need to do is take your current payout, subtract your past payout, and then divide it by the past payout, and then multiply it by 100. So that's a 10.25% increase. Clorox, for example, they've had I believe it was like I'm not going to give estimates because I think it was some other company I was following, but 0.96 minus 0.84 divided by 0.84. Okay, so they had a 14.28% increase, so that's very healthy. Imagine if you bought the stock and every year they increase their dividend by, say, 10 to 14%. Using the rule of 72, 72 divided by 10, you would double your initial dividend payout in a little over 7 years. Your initial payout rate, your initial cash flow, your dividend payout would double in 7 years if you never deposited more money. But if you reinvested those dividends, it would compound very quickly, and you'd be able to buy more shares, especially if the price continued to fall a little bit, but they continue to raise their dividend. You'd be buying at a cheaper price and just be able to reinvest those faster. So speaking of fast, ticker symbol FAST for Fast Now is number 3. They have General Building Materials. They've been increasing and paying dividends. They've been increasing their dividends for the last 7 years, since back in 2011. They do have a decent payout ratio at 59%, so this is under 60%. Their dividend yield sits right around 3%, depending on the price and the day. Their ex-dividend date is on April 24th, so that's next Tuesday. So you do need to buy this stock on Monday or prior, and then you'll get paid out on May 23rd. They do have some special payouts here. So the reason they did cut their dividend here shortly. Back in 2013, they did a stock split, and they continued to pay out their dividend for the stock split, raised it for a little bit, and then 2013 there was some financial mess that kind of took place around different stocks, so they did do a special payout of 50 cents, cut their dividend for about a quarter, and then bumped it back up here. So they have increased it for the last 7 years. If you've held on to them, the special payout, if you held on to it during that time, you wouldn't have cared about that cut because the special payout would have, lapsed that dividend cut there. And then number 4, we have Hallador Energy. This shows dividend growth of 1 year, whereas their information below shows that they haven't increased their dividend since, they've never increased their dividend. I believe they started paying dividends back in 2009. And have just continued to pay out the same dividend at 4 cents per share. So here you can see they pay out 16 cents per share. You divide that by 4. That's 4 cents per share each quarter. They have a pretty high payout ratio for being a mining company, and their dividend yield is 2.3. So this stock has the next dividend on Friday, so you do need to buy them on Thursday or prior, and then you'd be eligible for that payout on May the 11th. And this one, as I said here, they haven't had a dividend increase for some time, since back in 2012 they began paying out dividends at 4 cents, and they have continued to pay out dividends at 4 cents since back in 2013. Prior to then, they did have special payout ratio or special payouts, but looking at this one, I wouldn't recommend this one. This one just came in on my list because it did meet the financial metrics, but the financial metrics are only one, it's just one piece of the screening process. This very quickly gives me 40 stocks, takes it down to 4 stocks. Now I can use those financial metrics that, I screened 40 stocks. Now I can go take a look at the next screening process. What's their payout ratio? How long have they been paying out dividends for? How often do they increase their dividend? What percentage do they increase their dividend by? And then, okay, it beats that criteria. Then now I'm only left with 2 stocks. For example, because I want some healthy looking stocks, I would knock this one out right here automatically, because I like to see some stocks that have fast graphs. I like to see some sort of history when I am purchasing for the increase in dividend in the future. So these 3 here, Clorox, Williams-Sonoma, and Fast, would make it to phase 3, where they have been paying out dividends for quite a while, for nearly 10 years. They may uphold the next recession because they have that increase in revenue, free cash flow, net income. Now I would, step 3 is go take a look at their financials, their balance sheet. Go look over that information, see if it matches there. Read over their last quarterly earnings reports and their last 5 to 10 years of yearly reports of how, look at areas during those times of, they've had issues. So that is it for this video. So again, 4 stocks to take a look at and do a deeper dive into would be Clorox with 40 years of dividend growth, ticker symbol CLX. Number 2 is Williams-Sonoma, ticker symbol WSM, with 8 years of dividend growth. Number 3 is Fast, ticker symbol FAST, with 7 years of dividend growth. And stock number 4 is Hallador Energy, ticker symbol HNRG, with 0 years of dividend growth and a pretty high payout ratio. So let me know in the comment section below if you guys own or are looking or will look into any of these stocks. And of course, thank you guys for watching up until this point. If you did like the video, remember to like, comment, and subscribe for future financial videos. I do appreciate you guys out there. If you have any questions or just want to say hello, please leave me a comment in the section below, and I will always reply back to you guys. As a friendly disclaimer, I am not a financial advisor or tax professional. The information provided is my opinion for entertainment and fun. This is not investment advice. This is just me as a financial investor myself, trying to help others make their money work for them, looking for some good discounts. And one other tip is I like to take a look at price yield over the year. And what I like to look for is a yield trading above the price, meaning that the stock price has came down, which could be a good opportunity to buy very low and wait for that stock to recover. You can see the difference here between this bottoming out point at 124 and this peak here at 150. That's a pretty big difference, where if you buy now at the low, you may have that ability to trend upwards if the financial the balance sheet, the 10Ks, and this last quarterly reports turn out to do well. So that's it for this video. Thank you guys for tuning in. I will see you next time. Have a great day. Bye bye.